My name is Rahdric C, financial advisor and founder of the Goods Virtual World. Welcome back to Good Wealth. In the previous modules, we mastered the client, investment company structures, variable products, risk architecture, behavioral finance. Now we move into one of the most important systems in the financial world, retirement accounts. Because this is where taxation, compounding, government policy, and long-term wealth strategy all intersect. And elite advisors understand something most people never fully grasp. Retirement planning is not just about investing. It is about controlling taxation across time. Write this down. Retirement planning is tax strategy stretched across decades. Now let's begin with the core distinction. Qualified accounts versus non-qualified accounts. That distinction controls almost everything. A qualified account receives special tax treatment under IRS rules. Examples include traditional IRAs, 401ks, 403bs. Write this down. Qualified accounts receive tax advantages from the government. Now pause and think. Why would the government provide tax advantages for retirement accounts? Because the government wants individuals to save for retirement independently. That incentive structure is the foundation of the system. Now let's move deeper. Traditional retirement accounts are generally funded with pre-tax contributions. That means the investor may receive a tax deduction today, but will pay taxes later during withdrawal. Write this down. Traditional retirement accounts defer taxation into the future. Now let's apply this. A client contributes $10,000 into a traditional IRA. If that contribution is deductible, what happens to their taxable income this year? It decreases. That is immediate tax relief. But here's the trade-off. The IRS eventually wants its share, which means withdrawals in retirement are generally taxed as ordinary income. Now let's compare this to a Roth IRA. A Roth IRA uses after-tax contributions. The investor pays taxes now, but qualified withdrawals later are tax-free. Write this down. Traditional accounts delay taxes. Roth accounts eliminate future taxes on qualified withdrawals. Now pause and think. Which strategy is better? The answer depends on future tax expectations. If the client believes taxes will be higher later, Roth may be more advantageous. If the client needs tax relief now, traditional may be more appropriate. That is strategic planning. Now let's elevate this to institutional thinking. Elite advisors do not ask, "What account should I use?" They ask, "Where should this client recognize taxation across their lifetime?" That is a completely different level of thinking. Now let's go Ivy League level. This introduces the concept of tax diversification. Write this down. Tax diversification means spreading future tax exposure across different account structures. Why does this matter? Because future tax law is uncertain. A client with only taxable retirement income may face significant future tax pressure. But a client with traditional accounts, Roth accounts, taxable brokerage assets has flexibility. And flexibility creates strategic control. Now let's move into contribution limits and penalties. Retirement accounts are heavily regulated. The IRS uses penalties to discourage early withdrawals. Generally, withdrawals before age 59 and a half may trigger ordinary income taxes, plus a 10% penalty. Write this down. Retirement accounts prioritize long-term preservation over short-term access. Now let's apply this. A 45-year-old investor withdraws money early from a traditional IRA for non-qualified purposes. What is the likely consequence? A. No taxation applies. B. Capital gains treatment only. C. Ordinary income tax plus potential 10% penalty. D. Tax-free withdrawal. The correct answer is C, because retirement accounts are designed to preserve long-term retirement capital. Now let's discuss required minimum distributions, also known as RMDs. At a certain age, the IRS requires investors to begin withdrawing funds from traditional retirement accounts. Pause and think. Why? Because the government eventually wants to collect deferred taxes. Write this down. RMDs force taxable distributions from tax-deferred accounts. Now let's move into employer-sponsored plans. A 401k is an employer-sponsored retirement plan. Many employers offer matching contributions. This is one of the most important concepts in retirement planning, because employer matching is essentially guaranteed return. Real example. An employer offers a 100% match up to 5% of salary. If the employee contributes 5%, the employer contributes another 5%. That is immediate capital acceleration. Write this down. Employer matching is one of the highest return opportunities in personal finance. Now let's discuss rollover risk. When clients change jobs, retirement assets are often rolled into another account. This is where mistakes happen. An indirect rollover places the capital into the client's hands temporarily. That creates timing risk. If the client fails to complete the rollover within 60 days, the IRS may treat it as a taxable distribution. Write this down. Indirect rollovers introduce taxation and penalty risk. Now here is the elite level distinction. Direct rollovers eliminate unnecessary risk. Because the capital moves institution to institution without the investor taking possession. Elite advisors minimize friction inside the system. Now let's discuss behavioral finance again. Retirement investing is emotionally difficult because the reward is delayed. Human beings naturally prioritize short-term gratification over long-term outcomes. This is known academically as present bias. Write this down. Present bias causes individuals to undervalue long-term rewards. That is why automatic investing works so effectively. It removes emotional decision-making from the process. Now let's apply another question. Which retirement strategy best mitigates present bias? A. Waiting for market pullbacks. B. Lump sum speculative investing. C. Automatic payroll contributions. D. Frequent portfolio trading. The correct answer is C, because automation reduces emotional interference. Now step back and connect everything. Retirement planning is not about picking accounts randomly. It is about tax management, behavioral management, time horizon management, liquidity planning, and strategic capital allocation. That is how professionals think. Now, final lock. Qualified accounts receive tax advantages. Traditional accounts defer taxation. Roth accounts allow tax-free qualified withdrawals. Tax diversification creates future flexibility. Early withdrawals may trigger penalties. RMDs force taxable distributions later in life. Employer matching accelerates wealth accumulation. Direct rollovers reduce taxation risk. Present bias undermines long-term investing. Retirement planning is long-term tax architecture. If you understand this at this level, you are no longer memorizing retirement account definitions. You are understanding how governments, taxation, behavior, and compounding interact across decades of financial life. And that is the difference between passing an exam and thinking like a true wealth strategist. You just got the goods from the goods.